Introduction. The foreign exchange market, Forex or FX for short, is one of the most exciting, fast-paced markets around. Until recently, Forex trading in the currency market had been the domain of large financial institutions, corporations, central banks, hedge funds, and extremely wealthy individuals. The emergence of the internet has changed all of these, and now it is possible for average investors to buy and sell currencies easily with a click of the mouse through the online brokerage. Differences between Forex and equities? Well, the advantage for investing in Forex industry is that you have a 24-hour trading, you have a minimal or no commission cost, instant execution of market orders, short selling without an uptake, no middleman, and of course, no market manipulation. Why trade in Forex? With the average daily turnover of 4 trillion US dollars, Forex is the most traded financial market in the world. A true 24-hour market from Sunday 5 p.m. Eastern Time to Friday 5 p.m. Eastern Time. Forex trading begins in Sydney. It moves around the globe as the business begins first in Tokyo, second London, and then New York. Unlike other financial markets, investors can respond immediately to currency fluctuations whenever they occur, day in or day out. Symbol codes for currency pair. When a currency is coded, it is done in relation to another currency, so that the value of one is reflected through the value of another. Therefore, if you are trying to determine the exchange rate between the US dollar and the Japanese yen, the Forex code would look like this: USD/JPY equals 119.50. And for Euro and US dollar, it's EUR/USD equals 1.3820. What is bid and ask? As with most trading in the financial markets, when you are trading a currency pair, there is a bid price, or what we call sell, and an ask price, which is buy. The bid is the price at which you can sell the base currency, and the ask price is at which you can buy the base currency. For example, USD/CAD equals 1.2000/05. The bid is 1.2000 and the ask price is 1.2005. What is spreads and pips? The difference between the bid price and the ask price is called a spread. If we were to look at the following code, for example, you have EUR or Euro/USD, US dollar, equals 1.2500/03. The spread will be 0.0003 or 3 pips, also known as points. And then what is pip? It is the smallest amount a price can move in any currency code. In the case of the United States, it's dollar. In the case of euro, it's the British pound. And in case of Swiss franc, 1 pip would be 0.0001, and with the Japanese yen, 1 pip would be 0.01, because these currency is coded to 2 decimal places. Balance, equity, and margin. What is balance? Balance is the amount of capital left. Even when there is a trade on, the balance amount will not fluctuate along with the floating profit or loss. For equity, equity is equals balance plus profit or loss, depending on the movement of the price you trade, can be profitable at this moment but not the next second. So your equity amount will be fluctuating until you have liquidated your current trade. And for margin, leverage. More leverage means more opportunity and more risk. Trading using leverage offers significantly increased profit potential. But it is important to remember that it also is significantly increasing with risk. Forex trading offers leverage up to 50:1. This means that for every $1 in your account, you can trade $50 worth of a position. The leverage is 200:1 or 1:200. Also, we have 400:1. What is technical analysis? Technical analysis attempts to forecast future price movements by examining past market data. Most technical analysts make a few key assumptions. All market fundamentals are reflected in price data. Moods, differing opinions, and other market fundamentals need not be studied. History can repeat itself, often in regular, fairly predictable patterns. These patterns generated by price movements are called signals. A technical analyst's goal is to uncover a current market signals by examining past market signals. Prices move in trends. Technical analysts believe price fluctuations are not random and unpredictable. Get in and get out at the right time. Traders rely on price charts, volume charts, and other mathematical representations of market data, called studies, to find the ideal entry and exit points of a trade. For some studies, it helps identify a trend, while others help determine the strength and sustainability of that trend over time. Technical analysis can add discipline and minimize emotion in your trading plan. It can be hard to screen out fundamental impressions and stick with your entry and exit points as planned. While no system is perfect, technical analysis helps you see your trading plan more. Price chart types. We have the bar charts. The most common type of chart showing price action. Each bar represents a period of time. A period as short as 1 minute or as long as several years. Over time, bar charts can show distinct price patterns. Candlestick charts. Instead of a simple bar, each candlestick shows the high, low, opening, and closing price for that period of time it represents. Candlestick patterns provide greater visual detail as they develop. Point and figure charts. Point and figure patterns resemble bar charts patterns, except X's and O's. Technical indicator types. Trend. Trend is indicators smooth price data out so that a persistent up, down, or sideways trend can be easily seen. For example, moving averages or trend lines. Strength. Strength indicators describe the intensity of market opinion on a certain price by examining the market position taken by various market participants. Volume or open interest are the basic ingredients of strength indicators. Forex technical indicators. Stochastics, Relative Strength Index or RSI, Bollinger Bands, and Fibonacci retracements. Cycle. Cycle indicators indicate repeating market patterns from recurrent events such as seasons or elections. Cycle indicators determine the timing of a particular market pattern. For example, Elliott wave. Support resistance. Support resistance. Support and resistance describe the price levels where markets repeatedly rise or fall and then reverse. This phenomenon is attributed to basic supply and demand. For example, the trend lines. Momentum. The momentum indicators determine the strength or weakness of a trend as it progresses over time. What is fundamental analysis? Fundamental analysis studies the core underlying elements that influence the economy of a particular entity, like a stock or currency. It also attempts to predict price action and trends by analyzing economic indicators, government policy, societal and other factors within a business cycle framework. Forex market drivers. The rising interest rates strengthen that country's currency. A common way to think about interest rates is how much it's going to cost to borrow money, whether for our mortgages or how much we'll earn on our bond and money market investments. Interest rate is a policy key driver of currency prices and typically a strategy for new currency traders. Oil-dependent countries weaken as oil prices rise. Just as airlines and other oil-dependent industries are hurt by rising oil prices, so are the currencies of oil-dependent countries. The economic indicators. Economic indicators are snippets of financial and economic data published regularly by governmental agencies and the private sector. These statistics help market observers monitor the economy's pulse, so it's no surprise that they're religiously followed. These statistics help market observers monitor the economy's pulse, so it's no surprise that they're religiously followed by almost everyone in the financial markets. Now, you need not understand every nuance of each data release, but you should try to grasp the key. There's a large-scale relationships between reports and what they measure in the economy.